But now it's time to welcome Jon Najarian. We're always happy when Jon can join us to share his valuable financial insights here on the Income Generation. And he started his career as an options trader at the CBOE in 1981, following a stint as a professional football player with the Chicago Bears. He now runs his own investing education website, Investitute.com, and is the author of the book, How I Trade Options. He's also regular on CNBC's Fast Money and is always in high demand as a speaker and a market analyst. Jon, welcome back to the show.
Great to be back with you, David. Thank you, sir.
All right, so let's talk football. No, I'm just kidding. I'd actually like to talk football, but this is a financial show, so we can't talk football. Maybe a little. So how about this crazy stock market in October? What do you make of this?
Well, I think it was a little bit of a taper tantrum sort of thing, David. We saw the same thing in February. The market was at the highs. We got back to those highs just in September. It took that long, 152 days after that sharp sell-off in February. And that's the same thing we experienced in October. I think there are some big differences, but that's one of the big similarities is that people just weren't ready for higher interest rates. No matter how much the Fed talked about it, they just weren't ready for it.
So what are some of those big differences that you're referring to between now and earlier this year?
Okay, one major one is that the European markets, like for instance Germany, their 10-year bond was up around almost 0.9%, the highest it had been since the financial crisis. This time around, David, it's right around a third of 1%. In other words, 0.3 versus 0.9. That's a big difference. And the reason for it, of course, is the just minimal job growth, minimal GDP that we've seen out of the biggest economy in Europe, which is Germany. Mm-hmm. And the same goes virtually across the board in Europe. So when you've got interest rates at a much lower level in Europe, I don't think ours can run a lot higher. When they were at 0.9, yeah, we could pop a little more. This time around, they're taking their rates back down to zero and towards negative again. I think that's going to anchor our rates and not let them go a lot higher than where we got to when we hit 3.25 on the 10-year.
So if everyone's tightening at the same time, not so much of an issue. But if you have some easing going on over there and we're tightening here, it becomes a problem. Good thing, bare minimum, at least the Italian 10-year bond now has a higher rate than ours. That's good news. At least that's starting to price itself a little bit more appropriately. How about the GDP, though? The GDP would make an opposite argument. You know, when we talk, going back to February, the GDP was sub 2%. Now we've seen 4, we've seen 3.5. So do you think maybe that growth can offset the factor that you just mentioned?
Yeah, I think it does. I think the fact that our economy is still growing, that companies based in America are making more money for the shareholders because of the tax cuts and so forth, I think those are both positives. And they're much more competitive against Europe. And that's why you see European growth literally flat, if not down, across the board. I mean, Germany's down even. And as I say, that's the biggest economy in Europe. You look around at Spain and Italy, like you cited, David, the interest rates are higher in Italy, and that's because of risk.
Right.
But I think what's going on here is that there's just not a lot of appetite for those European stocks, and a lot of appetite comes back very quickly, like it has for the last few days, for American equities.
Sure. So in the 30 seconds or so we have left in this segment, tell us this last earnings, this third quarter earnings report so far, what have you seen? Any surprises with one sector doing better than you thought or another sector doing perhaps more poorly?
I think the biggest thing, David, was the tariffs and the drag that they are on certain segments. Obviously, for the Russell 2000 or the IWM, you know, the small cap stocks, not really an issue. But it has been an issue for Caterpillar, hasn't really affected Boeing, and because of negotiations, it hasn't really affected Apple. I think those are positives that they haven't been as affected. And it's going to be bad for China if these manufacturers start looking elsewhere for where they're going to want their goods.
Yeah, makes sense. So stay with us, John, and you stay with us too. We come back, we're going to ask Jon Najarian if he thinks the Fed is going to create the next recession. We'll be right back. Now, John, right before the break, you were talking a little bit about China, and I cut you a little short because you know how those commercial breaks go. But, you know, let's talk about this whole trade war thing. How do you think this is going to play out? Can a trade war be won? And if so, who's got the upper hand? Talk to us about that.
Sure. Well, right now we're winning. We being America. China's losing. And I don't think Xi Jinping and the Chinese can stick with their game plan much longer. And the good news for all of us is I don't think they will have to. They were very unlikely, David, to acquiesce and cave in, if you will, for the President of the United States ahead of the midterms, because that would just take away all their leverage. They're not dumb. But after the midterms, they have no leverage. So I think they're likely to cut a deal. They're already losing business to everywhere from Pakistan in the case of clothing and so forth to Vietnam and Korea in the case of electronics. So I don't think they can afford to have their people not working. And that's what's happening right now is with these tariffs, they have had to basically idle some of these factories. I think they get back to holding on to the customers they've got, because if they went another 6 months like the last 6 months, I think they'd lose a considerable amount of business.
Now, it's funny you say that we're winning. You know, people would look at the GDP growth and say, well, their growth last quarter was higher than ours. They're winning. But then again, if you look at the change of their growth rate's going slightly backward and ours is moving forward. Or are you pointing to our stock market compared to theirs? Because our stock market would definitely agree with you that we're winning.
Both. I would point to both. In other words, as you said, David, our GDP is going like this from the lower left to the upper right. And meanwhile, the Chinese GDP, if you can believe it, because of course these aren't very verifiable numbers that they produce, is either flat or rolling over. And I think also the fact that their stock market is down 20% year to date, that's another thing that augurs against them, because obviously you don't stay in office very long, even if you think you're the premier for life, if you don't keep these factories running, don't keep these new workers that have moved into the cities working and thus eating better than they ate before when they were peasants living out in the rural areas.
Good point. Good point. So I teased up right before the break this comment about the Federal Reserve, switching gears here for a minute, and you know, is the Fed's now locked into raising interest rates. I'm concerned that they might actually create the next recession, as has happened in the past. Do you share those concerns at all?
I share those concerns, and beginning of this month, I think it was October 3rd or so, Chairman Powell, who's a very smart man, made, I think, a dumb comment when he talked about that we're pretty far from the neutral rate, meaning that he thought we were below the rate that we were going to get to over the next 6 to 9 months. Like I say, that spooked the markets because the markets had anticipated that we were going to see some rate hikes, but they thought we were already close to what the Fed thought was a neutral rate. And now with that statement, that's when the real aggressive selling began in the market, David. So I think what we're going to be looking at is him walking back those comments. And I think either going into the December meeting and or after that meeting, they'll be talking more about, we think we're about there now.
Right.
And I think that will be greeted with a rally rather than a recession.
In fact, John, I bet Chairman Powell wishes he could take those words back as we speak. But we got to take another break. Stay with us. We'll be right back on the Income Generation. So I guess what we're talking about is really that we have a couple issues. We have the Fed saying they want to be more aggressive in raising rates. We have the long end of the yield curve being artificially held down by, as you said, Germany and other foreign European countries whose long-term rates are down. So now it goes back to that argument that I've been bantering back and forth. You and I have talked about it before, for maybe going back a year or two, about the possibility of a flat yield curve and what that could do for the economy. That's got to be factored in too, correct?
Yeah, it does. And you also talked about the possibility that the Fed could drive us into a recession. It's something that you and I worry about. It's something the President of the United States worries about. And he's basically come out, not calling Powell out, but saying he doesn't think that they're doing the right thing, accelerating rates as they have throughout this hike cycle. I think that's about to stop, though. And if indeed it does, then I don't think you're going to be looking at a flat yield curve. I certainly don't think you're going to invert the curve if that happens. As you say, though, if they just stuck to the path of a December rate hike and 3 more in 2019, yes, they could drive us into a recession. And obviously the Fed doesn't want to do that.
So when you're doing your mental mathematics in this whole thing, how do you know, it's kind of like you take all these facts, you put them in a blender, you push the button, you see what comes out. So when you put the ingredient in the blender of this mushrooming federal deficit, what do you make of that? You know, are you in the camp that, hey, if we stay at 3.5 or 4% GDP, we can grow our way out of it? Or do you think that still that type of deficit is going to create a real issue?
I think the deficit creates a bigger issue, to your point about the Fed, if the Fed keeps hiking rates, because obviously we're paying back at a higher rate. So that's a real issue with the deficit. Deficits are easier to stomach when the rates are closer to zero. When they're moving up and we've got a 10-year rate that's at 3.10, let's say right now, obviously that's a bigger problem than when it was 2% a year ago. So I think the president and the Congress need to pay more attention to deficits here, because I don't see us heading back to 2. But on the other hand, I think cutting back on the deficit, we've had record inflows of tax receipts, highest on record, and yet we're still outspending what we're taking in. So obviously we know which side of the equation is the problem, and we've got to address that.
Now, John, final question is, we talk a lot about fixed income and generating income, and, we don't have a lot of stock market gurus like yourself on the show, but you're one of the ones that seem the reasonable middle of the road. I think you've said in the past that, hey, once people's income needs are met, then fine. The stock market's a great place to be with extra money. So with our income generation viewers' extra dollars, what do you see in the stock market? What's your crystal ball see for 2019 and 2020 moving forward in the last 45 seconds or so in this segment?
Sure. I think that overall we've got a market that could still push a lot higher. And I do think that stocks in particular that could be playing catch up are stocks like Caterpillar. It's a great global company. And if you see lessening of the rhetoric between the U.S. and China, if you see President Trump at the G20 talking to Xi Jinping, shaking hands and all that, I think those are going to be positive signs, obviously for Boeing, but it's not far from its 52-week high. Caterpillar, on the other hand, really needs that kind of help. And I think stocks like Caterpillar and Honeywell would do extremely well if we can come to some sort of agreement on tariffs.
So it sounds
That's
like,
what I'd say for 2019.
So your optimism is about getting an agreement on tariffs, which you think will happen, and maybe long-term rates in Europe, keeping our rates down to keep the economy moving. So John, my pleasure. Thank you so much for being on the show once again. You stay with us. We'll be right back with more here on The Income Generation. We'll be right back.